In this week's video, we'll examine a similar low volatility, no 5% corrections period in history to help us better understand what are the odds of a 20% plunge in the stock market. This is the 1934 to 2017 yearly chart of the S&P 500 that we covered in last week's video. It'd be very easy to look at this chart and dismiss it with the argument the present day is significantly different from the 1982-1984 period here. And since no two periods in history are alike, that would be a relatively accurate statement, just as it would be accurate to say 1982 and 1984, this period here, was significantly different from this period here. The important takeaway is the combination of factors, fundamental and technical factors, that were present here were similar to the combination of technical and fundamental factors that were present here, and the same argument can be made for the present day. Ultimately, the combination of technicals and fundamentals here produced a shift from an indecisive net aggregate opinion to a bullish net aggregate opinion. And the same thing can be said from this period here to this period here, and this period here to this period here. While all three periods have unique characteristics, they have similar characteristics. The chart patterns are similar, and as MarketWatch noted in a February 1st, 2018 article, you can make an argument that the demographics in the present day are similar to the 1950s. We also made a rational argument using facts back in September of 2017 that the present day from a demographic perspective is also similar to the early 1980s. Note, we're using the term similar, not identical. No two periods in history are identical. You can find the full text of this MarketWatch article by Googling this title here. For our purposes, the key takeaway was the fact that a recent Standard & Poor's report said the unemployment rate in the present day could drop down to levels last seen in the 1950s. And a big driver of that, in their opinion, is the seismic demographic shift that is underway in the present day. Since we've compared this period here to the present day on numerous occasions in past videos, and since we have similar characteristics from an unemployment perspective, possibly, and a demographic perspective between the present day and the 1950s, as well as these similar chart patterns, in this week's video, we'll explore a period in history that's similar to the present day from this perspective. Calendar year 1954 featured very strong trends with very little volatility and no 5% pullbacks, which of course sounds familiar to us in the present day. And given that we've used historical charts recently to make the very rational argument that a period of extremely low volatility with very shallow pullbacks tends to align historically with the early stages of a long-term, multiple-year secular trend, rather than the latter stages of a bull market. Therefore, if 1954 is similar to the present day, we can learn something potentially about future volatility by extending this 1954 chart into the future. Now we're looking at the same point A here, 1954, all the way to the end of calendar year 1957. And if we add in the magnitude of the pullbacks, you can see, like the present day, 1954 featured a relentlessly strong bullish trend with very shallow pullbacks that were followed by new highs soon thereafter. And since we know that easier markets are typically followed by harder markets, we wouldn't expect to take this 1954 chart and keep pasting it on top of this chart, because it's not realistic to think that the volatility profile will remain this tame going forward. And in this case, as we can see, volatility did indeed pick up. Clients and regular viewers know that the CCM market model uses hard data, or the facts in hand, to help us discern between volatility to ignore and volatility to respect. One of the quick takeaways from this chart: after 1954, did the stock market roll over? It did not. The period of low volatility and strong trends was followed by significant gains, and as we would expect, increasing volatility. To help us frame our conversation, if we had $1 million invested heading into calendar year 1954, invested in the S&P 500 index, and we held it from point A to point B, our $1 million would have grown hypothetically to just over $2 million. But if we continued to hold from point B down to this low here, we would have experienced a drawdown of 13.47%, which is significant. And all things being equal, we would prefer to mitigate this damage and preserve some of our principal between point B here and this low. And as we review the hard data during this period, we'll be able to show why our bias in the green box is to treat volatility as volatility to ignore. Notice I'm saying our bias. Doesn't mean we throw all caution to the wind. And eventually the hard data deteriorates in a way that when we get to the right side of point B, or inside of the orange box, our bias will be to treat volatility as volatility to respect. So for the purposes of our discussion, let's treat this as point A, point B, point C. This high in 1957 is point D, and this low late in calendar year 1957 is point E, as in Edward. Common sense tells us that a steep bullish trend with very low volatility and shallow pullbacks is indicative of strong bullish conviction. Common sense would also tell us that this most likely has some type of fundamental backing. And with the benefit of hindsight, the strong bullish conviction in this period here was handsomely rewarded, because the stock market went up all of calendar year 1955 and halfway through calendar year 1956. So with the benefit of hindsight, this was not irrational behavior if you were in the market here. In fact, it turned out to be very, very rational and rewarding. And if we followed the math and the model and were patient during these shallow pullbacks, every single time between point A and point B, we would have been rewarded by a higher high. So theoretically, it would have been possible to have our $1 million down here and end up with over $2 million here and make 0 trades between point A and point B. We say theoretically because the model is not going to throw all caution to the wind between point A and point B, meaning some defensive action on an incremental basis may have been taken in these areas here. But once we get to the right side of point B, patience is no longer rewarded with a higher high. And now we start getting into some pretty serious drawdowns. Therefore, would the hard evidence and the model been helpful in terms of discerning between, for the most part, volatility to ignore and volatility to respect? Since we know all things being equal, we would prefer to mitigate or avoid a 13% drawdown on our capital. We'd also like to avoid something like this. This is a 20% drawdown from point D to point E. Therefore, in the balance of the video, we're going to compare this period here, this peak, on August 2nd, 1956, and this peak, July 15th, 1957, to the present day. And that will help us answer two questions. Question number one, what are the odds of a 20% plunge in the stock market? Question number two, would we have been forced to anticipate, prepare for, or forecast to mitigate some of this damage here and or this damage here? Or could we have made prudent decisions based on the facts in hand on August 2nd, 1956, and in this period here to mitigate some of this drawdown or avoid hoping for the best between point B and point C and point D and point E? So let's start with point B, August 2nd, 1956. It would have been very, very helpful to have some yellow flags in here telling us that this decline here might be more substantial and pronounced and prolonged than anything we had seen on the left side of the chart. So when we click forward, this point B is identical to this point B here. And since we're looking backwards from the peak, we're not cheating, we're not looking ahead, we're only looking at the data that we would have had in hand on August 2nd, 1956, when the stock market peaked. And like we do in all of our videos, we'll be using generic and for illustrative purposes only simple moving averages. Generic means these are not the moving averages used by the model, and we're using them to illustrate basic concepts used by the model. So this chart is looking backwards 13 months from August 2nd, 1956. So let's review some things that jump off the page here and then compare them to the same chart looking back 13 months in calendar year 2018. Between July and October 1955, price, forget the moving averages, tells us our trend is starting to wane. How do we know that? We can draw a horizontal line that attaches the S&P 500 in July, and it's in the exact same place, no progress in October. Horizontal lines look like consolidation. This doesn't look like a strong trend. Number two, price has come down into the moving average cluster before the peak. I can see this, measure it, and put it in a model 1, 2, 3 times. And another thing that jumps off the page if you study charts for hours and hours and hours. Another sign of a waning trend, price goes down between the pink and purple moving averages on the first pass. It gets deeper into the moving average cluster on the second pass and deeper still on the third pass. If really bad things are going to happen, eventually price has to get on the other side of the moving average cluster. And every time we dig deeper into it, we're getting closer to the other side. We can see all of this before the peak. Another yellow flag. Price goes absolutely positively nowhere for 9 months here. We can draw a horizontal line and hit price 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times. More evidence of a waning trend. What else jumps off the page? Our moving averages have a wet spaghetti look. Rather than being strong, this is conviction down here. We're getting that wet spaghetti look with the moving averages in here, which is also indicative of a waning trend. And unlike this period back here, we have much, much higher volatility that we can see and observe before the final high is made. Before peaking, the S&P 500 on August 2nd, 1956, checked all of these waning trend, we should pay closer attention boxes. How many of these boxes can we check if we look backwards 13 months in the present day using the exact same generic and for illustrative purposes only moving averages? The answer is 0. The present day trend is much, much stronger than the trend on August 2nd, 1956. The strength of this trend speaks to the probability of good things happening, looking out into the future, relative to the probability of bad things happening. Just as all of this evidence speaks to the probability of bad things happening relative to the probability of good things happening. Even when we have a very, very strong trend, as we do on February 1st, 2018, the probability of really bad things happening, like a 20% pullback, that probability is never 0. But given what we know today, the probability of good things happening relative to the probability of bad things happening is much more favorable in the present day than it was on August 2nd, 1956. Therefore, we've just shown that this concerning drawdown here, the present day, really doesn't look really anything like August 2nd, 1956, telling us that the odds say the volatility that we'll experience in the future will probably look more like this. And the odds also say that it will most likely be followed by a higher high if we're patient, relative to seeing something like this. And emphasize enough, the odds of seeing something like this in the present day are not 0. We're talking about relative odds. That's how we use probabilities. The odds of good things happening over here might be 99%. The odds of bad things like this happening might be 1%, but they're not 0. We also showed earlier that this is a 20% drawdown. If we look backwards from this point here, would the data have been helpful? And how does it compare to the present day? So this point D here, July 15th, 1957, this point D is identical to this point D here, July 15th, 1957. Using the same concepts, what jumps off the page here before a 20% drawdown occurred? Number one, forget the moving averages. We have a multiple month downtrend here. This downtrend lasts 1, 2, 3, 4, 5, 6 months. This is a yellow flag. Number two, if we stick with the macaroni theme, rather than a wet spaghetti look, our moving averages have a bow tie macaroni look. And if you want a visual, here's our downward sloping bow tie macaroni. This is the left side of the bow tie here. Here's the center of the bow tie where my moving averages get very, very tight. And we know when they get tight and price moves away, really bad things can happen. Or really good things can happen when we move in this direction. And this is the right side of my bow tie here. What else jumps off the page? Before the 20% drawdown here, blue, our fastest moving averages on top. We go from a full bore bullish look with our moving averages and price here to a full bore bearish look in this area here. This looks quite a bit different than this. This look here speaks to significantly different probabilities relative to this look here. And unlike this period here, before the 20% drawdown, yellow flags are waving in the form of the moving averages. All of them have negative slopes here, which is a polar opposite to the left side of the chart here. No forecasting is needed to see this before the peak. If I pulled price off of the page, even my moving average cluster is in a downtrend. It's making a series of lower highs and lower lows. Price has made a significant lower low. This low here is lower than this low, this low, this low, and the lows over here. And when we reach July 15th, 1957, we have all of these we should be concerned boxes checked, and price ends up making a discernible lower high. Bullish conviction is not able to push the market above this high here, and we fail. We could check all of these boxes before the big decline. How does all of this compare to the present day? Do we have any of this? The answer is no. We haven't had a multiple month downtrend. We don't have a bow tie macaroni look. Blue is on top. It's not on the bottom. All of my moving average slopes are positive. My moving averages remain in an uptrend. We haven't made a lower low, a significant lower low, and we have not made a significant lower high. All of this speaks to the probability of good things happening from this point here relative to the probability of bad things happening. All of that relative to those same probabilities at this point. As we noted on Twitter this week, this quote from Seinfeld provides a nice analogy for the present day market. Elaine, breaking up is like knocking over a Coke machine. You can't do it in one push. You got to rock it back and forth a few times, and then it goes over. How long did it take in this case for market participants to push the Coke machine over? The answer is roughly 2.5 years. We get the net aggregate opinion of all market participants rocking here. The increased volatility tells us to pay closer attention, that it might be close to being pushed over. It typically doesn't take one push to go from a market like this to a market like this or this. It typically takes time. And even if you get a dislocation out of a profile like this, it's typically a relatively short episode, and a higher high comes in relatively short order. We don't have a strong profile in here, and thus we're more vulnerable to sharper pullbacks, corrections, downtrends, and bear markets. It's extremely important for us to understand these concepts, because without proper implementation and the proper mindset and the proper emotional stability, the model is basically useless. This strong profile here is basically saying try to hang in there, because typically good things can happen for a long period of time. Since the Coke machine doesn't push over on one try, we have a reasonable expectation that volatility will be followed by a higher high. And we know our goal is to navigate between a point A and a point B that could be several years down the road. It's fair to say this point here could be similar to the present day, telling us that the Coke machine might rock back and forth for 1.5 years before rolling over. It's in the realm of possibility. So what's the moral of the story here? How do we use all this going forward? Number one, strong trends can be like Coke machines. Strong hard data profiles are typically followed by higher highs. The data helps us with discipline and patience. This strong profile is telling us don't overreact to volatility. Make the hard data force you out. The odds and the hard data here tell us that keeping a cool head, calm, cool, and collected, even keeled, that type of logical behavior is often rewarded by a higher high. And the most important thing, if we keep a cool head, not only do we get a higher high, but we get higher profits. If we hold during this pullback here, at this point here, our account balances should hit a new all-time high. If we hold here, our account balances should hit a new all-time high. So our primary objectives in this period are as follows. Our number one goal when the odds are in our favor is to make money. That's why we're doing this. We're in the stock market to make money, not avoid volatility. So while the odds are in our favor, we have to understand that volatility is a necessary evil. To capture this gain, 100% gain between point A and point B, or even a high percentage of it, we have to understand that volatility is not the enemy. It's a necessary evil of making money between point A and point B. It doesn't mean we throw all caution to the wind, but mitigating volatility is a much lower priority than making money when the odds are in our favor. And since we don't throw all caution to the wind, we still think about principal preservation. But it's not the top priority when the hard data says we can focus on trying to make money. But eventually, the hard data deteriorates in a manner that forces us to change our primary bias from volatility to ignore to volatility to respect. And thus, our objectives need to be adjusted, because this hard data profile really doesn't look anything like this profile. This upward sloping line screams high conviction, and this is quite a bit different than this, which is screaming, do not treat your capital in this area here the same way you did back here. And the observable evidence is telling us to adjust the hierarchy of objectives from this to this. Now, principal preservation is the number one priority, not making money. Mitigating the impact of volatility is a much, much higher priority over here than it was back here. And since we're not using the hard data to predict, it's extremely important when we get into one of these negative profiles to take it day by day and maintain that flexible, unbiased, and open mind so we can redeploy our capital and shift our allocation when the data says it's prudent. I can't emphasize enough, the whole purpose for investing is to make money. When the odds are in our favor, if we take these objectives and throw them in the trash can because the pullbacks are just too much for us to handle, and we replace these objectives in this environment with these objectives, it's going to be next to impossible to make money. And if every time the market starts to pull back, we immediately shift 100% into the low probability objectives, we might as well not even be in the stock market, because the probability of making money is going to be so low that we'd be better off pulling our capital, putting it in CDs, and moving on with our life. We have to match our objectives, and more importantly, the hierarchy of objectives, with the data that we have in hand that we can see and measure. Because it's extremely important to make money between point A and point B. Because when we get into the orange box, we are going to mitigate volatility and mitigate the damage. We are going to give some back here and here. What type of exposure would the model have to the stock market here, here, and here? The answer, again, without getting too specific, over here, roughly 100% of the binary questions asked by the model and questions about hard data, questions like this, is this number above or below X? For the most part, 100% of them are coming back bullish in this area here, meaning our allocation to stocks, for the most part, over here would be 100%. When you start to get into volatility like this, that number is going to drop as the data starts to shift in an incremental manner. When you get here, the data, the Coke machine, is very vulnerable. This is telling you that because it's been going sideways. Our moving averages are rolling over, flattening out. It's an incremental model. So between this point here and this point here, we would have reduced our exposure to stocks to 0. When you get down here, for the most part, every single question asked about the market's health by the model, objective questions, no subjectivity, are coming back bearish. The same thing is true here. Since these are incremental moves, would we have been successful mitigating the volatility and the damage here? Absolutely, positively, yes. We'd be making incremental changes between this point here and this point here that would eventually get us from 100% stocks to 0% stocks. The hard data does improve some here, so some money would be reallocated to stocks, but you're still basically going sideways here. And when you roll over here, you're going to make incremental changes again, and when you get down here, you're completely out of the stock market. Compare and contrast these zeros to how the model has handled, let's say, the last 6 months, where it's maintained a 100% exposure for the most part to stocks. We do not want to send the message that anything in the financial markets is easy. Nothing could be further from the truth. But we do know if we remain disciplined and allocate based on the facts in hand, we can improve our probability of navigating between a point A and a point B, and we can mitigate the damage during a 13% drawdown, or in this case, a 20% drawdown from this point here to this point here. If we link back to the title slide, what are the odds of a 20% plunge in the stock market? If we want to be more specific, what are the odds of a 13% drawdown, or in this case, a 20% drawdown? Said another way, does the present day look anything like this period here, which was followed by a 13.47% drawdown? We've already shown with charts the answer is not really. And after this, the double-digit drawdown occurred. How about the 20% drawdown? Said another way, does the present day look anything like this period here? And we've already demonstrated, for the most part, the answer is it really doesn't look much like this period here at all. And after this, the S&P 500 experienced a 20% plus pullback. And for our purposes, does the present day look more like this period here, or does it look more like this period here, or this period here? We already know what these periods look like. Now let's compare the present day to this period here. If we're bullish, we want the present day to look much more similar to this period than these periods we've already covered. And if we review the same objective, generic, and for illustrative purposes only moving averages, that's exactly what we have. The end of 1954 unequivocally looks more like the present day than this period here or this period here. And we know if we're going to successfully navigate between a point A and a point B that could be several years down the road, we're going to have to take it day by day and continually ask ourselves during bouts of volatility, what are the odds of the stock market going on to make a higher high after the bout of volatility is over, relative to the market rolling over into a longer-term downtrend? And since we're all human, we know to navigate between a point A and a point B that could be several years down the road, going to have to think slow, monitoring the weight of the evidence to avoid these common missteps. Before we close, I think it would be helpful for clients to address a few questions and/or scenarios, especially within the context of concerns about rising interest rates. Markets can get awful jittery when they're concerned about interest rates rising at a rapid rate. How will we handle a situation where the next year and a half looks something like this? And how would we handle a 5.9% pullback, a 6.25% pullback, a 10.59% pullback, or a 7% pullback? And what happens if we wake up on Monday morning and we're faced with something like this? The answer to all of those questions, or any question related to how will we handle ... insert scenario or concern, our approach is always the same. We collect the latest set of facts. We run the mathematical models or probabilistic models. And then we ask, based on the facts in hand, are we allocated properly? If the answer is yes, as it's been for quite some time now, no action is needed, we do nothing, and we continue to repeat the process. At some point, the answer will be no. We'll make an incremental adjustment to get our allocation back in line with the weight of the evidence or the current set of facts. We'll use this logic for every type of market scenario that would include holding, making allocation adjustments, or dealing with a very rare Black Monday type event. So when do we anticipate that the answer will switch to no? The answer is we have absolutely positively no idea. We take it day by day. It could be Monday morning at 10 a.m. that the answer becomes no based on the data that we have in hand. It may be no in 3 weeks. It may be no in 3 months. It may be no in 3 years. Trying to answer that question, for the most part, is a waste of mental capital. How long do we anticipate that it will be before we switch from these primary objectives to these primary objectives? The answer is exactly the same. We have absolutely positively no idea how long it will be. And the migration from these objectives to these objectives will occur automatically based on the incremental changes that would take place in the data when we switch from a profile like this to an unfavorable profile like this. So when the market opens up on Monday morning, we'll be ready and prepared for any and all outcomes, from high probability outcomes to the lowest probability outcome. And if changes happen in a relatively slow manner, the model will adjust in a relatively slow manner. If we get a rare and odd dislocation event where the data deteriorates rapidly, the model will make allocation adjustments in a more rapid manner. Just as we've shown in this historical example, under our approach, there is no need to forecast or waste a lot of time wondering what Monday morning may or may not look like, because we're confident that we'll execute properly and we'll continue to ask the simple question, based on the facts in hand, are we allocated properly? As of Friday, February 2nd, 2018, based on the facts that we have in hand, the answer is yes. How long it remains yes is to be determined. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.